Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
But would see some type of capitulation out of emerging markets, in some type of money flowing back out of China. They have a big move in foreign direct investment and money flowing back in China, as you would expect. Money would flow out. And I think also one of the great things that the European Central Bank and even the European Commission has done is they've really done a good job of papering over to a degree and even making it look like the European banks are in better shape than they are. There's still a lot of massive risk in the European banking system. I think even a lot more risk that's left in the U.S. banking system. So these are the type of things we're watching for to see if money comes. It would come out part and parcel, and the money would again move back into U.S. Treasuries to hide, given the dollar a major risk bid. Again, back to what could be the major cause of a risk bid here. We still haven't seen this rebalancing of the global economy, and it's a big thing now that is back on the plate of the G20 this weekend in Pittsburgh. In fact, surprisingly, the U.S. came out last night, I guess it was, and said we need to put this idea of global rebalancing back on the table. This G20 meeting just can't be about regulation and beating up bankers. Not that beating up bankers isn't a fun thing to do. I'm sure it is. We'd all like to try it at times, but it does nothing really to move the economies forward. And this idea of global rebalancing really is the major global macro event in play, and it was triggered really by the credit crunch. If you haven't seen this before, it just says that the Western economies of the world have too much consumption. The Eastern economies of the world have too much overproduction, too much surplus production. And obviously, the overconsumption countries create the current account deficits. The overproduction or export-oriented economies create current account surpluses. United States on one hand and China are the poster countries for this global rebalancing. And what is very fascinating, and again why we have in the back of our head that this risk bid could come back into play, when you look at what the United States has done to try and create traction for themselves, they've done nothing but try to create more consumption in the U.S. They've created more leverage by pumping all kinds of debt in the market, monetizing the debt, which everybody you know what's going on there, to create more consumption, which was the problem that triggered this whole conflagration in the first place. What has China done? China has turned around and used their $2 trillion in stimulus and ultimately created more surplus production because most of it has gone in infrastructure development, real estate, and other things. They really haven't made major regulatory changes or major structural shifts in their domestic economy with all this money they spent. China is banking on a V-shaped rebound. So it's interesting that people are, really catching on to this, I think, in a very, very big way and saying ultimately, if this problem isn't solved and we continue to throw debt into the market, we're ultimately going to be back into the same problem that triggered this whole credit crunch situation in the first place. So that's something that I think we have to continue to watch. And what you would watch there is really just for exports is really the driver here. If we see exports start to rebound in China and we see imports to China start to rebound in a big way, and we start to see the U.S. consumer normalize and start buying more goods, then we know maybe we're in that slow rebalancing process. But the reality is, if the U.S. consumer is still dead in the water, he doesn't have income, he's worried about his job, he still has huge amount of debts, he's lost the wealth from the housing that got killed. He's probably still trying to make up some of the wealth, obviously, in the stock market, and we'll get to that in a second. But if the U.S. consumer is dead in the water and he's still the major demand driver in the world, the money that China has thrown in to its market is creating, again, over surplus and really sowing the seeds for lower growth going forward and lower final goods prices going forward, which is another reason why we think deflation is a problem that's going to be with us going forward, not inflation. The other the other upshot, so to speak, of this, if this rebalancing, is a trigger for the risk bid again, is that the export model is in for some more pain. If the U.S. consumer doesn't rebound, or if demand doesn't rebound in Europe on the consumption side, the export guys are in for pain, and most of the export-driven models come from Asia, although Germany you could also consider an export model country. We expect subpar growth really in the industrialized countries for a number of years. And the reason that's important from a risk bid standpoint is when you have subpar below capacity growth, your margin of error, your cushion in profitability, or your cushion in the banking capital side and everything else means that you're more susceptible to systemic risk in the world. And when everybody's making money and you have fat margins, you can handle some of that stuff a lot easier, obviously. But when we're coming off a very nasty period and trying to rebuild capital, and we have subpar growth, that sets up at least a scenario for a lot more volatility in the world and chance for this risk bid to happen. So that's kind of the story for the risk bid here, but I don't think it's really the major one that's in play at the moment, and we'll get to that in just a second. But on that scenario, obviously, as I showed you, the dollar rallies, the commodity currencies would get hammered. The commodity currencies have soared. Obviously, again, on the growth and yield, they've soared for good reason in this idea when China is blowing and going and continuing to suck up commodities, or at least the demand for commodities back on the table. The commodity currencies get that growth bid, and from a yield standpoint, not necessarily the Canadian dollar, which has pushed their yields down pretty far, but the Australian dollar really is the major risk appetite currency in the world. They're sitting at a little over 3.25% on the 3-month yields, where the U.S. is like 0.2%, for example. So you can see the towering yield and growth are drivers of the commodity currencies. If that growth idea comes off on a risk bid, those currencies we think will get hit very, very hard, and the euro would actually tank and fall again on a risk bid, just as it did the last time on the risk bid. We don't think the European economy has anything going, anything better really than the U.S. I think they're mired in the same type of problems, but the euro tends to get these bids and move very strong against the U.S. dollar just because it's the other key alternative currency, and we're seeing that in a big way. Another example of just how the Aussie dollar moves with commodities and moves with oil, which oil is a great representation of what people think growth will be in the world. As you can see, it's in pretty close lockstep with oil. Oil back above $70 today. Australian dollar looked like it was due for a nice correction yesterday, of course, which we tried to play and got burned. Popped right back up today, and oil's back over 70. So this correlation is tight, just to show you the idea that if there's growth changes in the world and everything all of a sudden is marked down, you're going to see oil and the other commodities come off along with it. The muddle through scenario, and I think the scenario is very much in play in the market right here, and I think it has a lot of validity. Let's go through a couple of different stages of this. The U.S. government, as we said, is just pumping more and more debt into the economy, the stimulator of last resort. One of the reasons we think that this has become back to an implicit policy for the U.S. government, if you remember, and let me go back a couple slides. Remember I showed you this slide right here. As the U.S. dollar came down from the upper left down to the right, you can see how it pumped up the other asset markets, pumped up the stock markets, pumped up commodities markets, pumped up global markets around the world. Well, when you have markets going up like that, it provides what's called the wealth effect for the consumer. And the U.S. is trying to do anything they can to try and bring confidence back into the consumer. And one way is to pump up the 401ks, pump up other global asset markets, provide that stimulus around the globe. They can do it with the U.S. dollar being the world reserve currency. Things are priced in U.S. dollars. So when the U.S. dollar supply is out there and the U.S. dollar-based credit, which was very much in demand after the credit crunch, gets back in there and lubricates these markets, it pumps up these bubbles once again.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.